Hello students, how are you all? All good? Today we will discuss investment properties. Video number 7. I told you in the last video and we had started concept number 6 in subsequent recognition. And I told you that in the subsequent recognition, there are two things you should keep in mind. First is repairs and other is replacement. After we buy the property, if we make any subsequent expenditures, we deal with that in subsequent recognition. If it's repair, it will go into P&L. If it's replacement, we will capitalize it. Repairs refer to daily servicing. The money is spent in order to maintain the asset's normal performance. There is no value addition, no contribution, and no increase in the performance of the property. Lift maintenance, property tax, wall repairs, and floor cleaning are included in the routine expenses. Operating expenses can be put in the P&L. However, when it came to replacement, we considered replacement as an improvement. And this is our capital expenditure. Because after replacement or improvements, property's value is increased. The performance gets better. Installing new elevator and the new floor, the new wall and the new ceiling, all these have been changed. You are doing value addition. Therefore, we capitalize this as a capital expenditure, then we apply depreciation to it. I told you about the two parts of replacement. So it will either be a replacement of a different component or the replacement will be of the integral component. I have just explained unit number 1 to you all. Different components. What happens in different components? The old component is derecognized. The difference between its carrying amount and its scrap value is added to P&L and close it and recognize the new component. The first entry passes bank debit, P&L debit to old component. Next entry is passed to new component account debit to bank and it starts depreciating based on its new life. Clear? I solved a question for it. Interior is in building and building's life is 50 while interior life is 15 years. Make two parts and calculate different depreciation on different lives. When different parts of asset have different lives, then we have to calculate depreciation separately for each life. Then we consider it a component. But students, I started today's class with unit number 2 and I will start my lecture. So let's start guys and make a heading on a fresh page. Okay. Please create heading on fresh page where I will start speaking slowly. Explanation on unit number 2 and this is integral component. Please listen to this point carefully. It's very easy. It's not difficult. Let's just say that we have an investment property. We have an investment property and the overall value of it is, that is 50 crores and the overall lifespan of it is 50 years. Let's assume this number. Inside this investment property, there is not at all any special component. Like in previous class, it was interiors. There is no such component whose life is different. Any of the different components inside the investment property was not identified when there is no component. So this means that this is a single asset and it has a single life. Calculated depreciation will be as per 50 years. So what you have to do is take 50 crores divided by 50 years. The depreciation of 1 crore will continue every year. You don't need to create tables or do any breakups. Also don't take any different lives or calculate different depreciations. Integral components means, so if I make any changes to this property and like if I do any replacement inside this property, then or do any improvement. So how will we do the accounting for it? There is a very simple way to accounting for this. Let's say that after 1 year, I had some replacements done. After 1 year, you think the property is still new. Let's say if after 10 years, after 10 years, I made some replacements or improvements inside this building. If there are no different components, how will the accounting be done? I will first calculate the carrying amount. What will I do with the carrying amount at the end of the 10th year? I will take 50 crore. I will subtract 10 crore. Why? 1 crore rupees is annual depreciation. What would it be for 10 years? 10 crores. So how much will be my carrying amount? 40 crores. Now I need to make an improvement. I need to make a replacement. I'm not going to do anything else. And then cost of replacement, I will add in it, and I will subtract scrap, if any, from old material. This will be revised carrying amount, and then I will divide this from 40 years. It will be depreciation. Now you must be thinking that we did the same as we did earlier, but that's not true. No. What was it before? Earlier we split off the property. Component 1, component 2. And column of the component that was being replaced was tempered. You didn't make any changes in second column. So guys, what is happening? There is a column as column 1. Overall. So you calculated the carrying amount on the date of replacement overall. You added the cost to it and minus the scrap. But guys, keep this in mind. The carrying amount is not being subtracted here. If you look carefully, the concept that we studied in previous class was that the carrying amount was reduced, right? This is WDV. We removed WDV of the old component. But I'm not removing WDV now. I'm subtracting the scrap. If you have anything, money that has gone from your pocket will be in plus, and the returned are minus. The amount you spent is added. If any scrap is received, it is deducted from the total. Why I couldn't deduct the carrying amount? When your property is itself overall, so the part that you are replacing, it will have a separate carrying amount, won't it? When we talk about the component, then the component is taken into account. And what is the carrying amount of this, and what about this and this? But when your property is overall a single property with a single life, and you make improvements inside it then, and the carrying amount is overall, the part you are replacing doesn't have a separate carrying amount. So how can you remove the carrying amount? You can remove scrap from it. This issue is in integral components. Meaning, if you ask me, this is the difference between the 7 different components and the integral. Then you realize because carrying amount of different components is different. How much did we get for scrap? How much is WDV and how much did you lose? But when we talk about integration, in that case, carrying amount of replaced portion is not separated because carrying amount is overall. So you won't even know how much loss you incurred during the replacement. Furthermore, we simply look at cost incurred in replacement. It will be in plus and the scrap value received will be in minus. So we got revised carrying amount, and in this same balance is depreciated over remaining life. I hope this is clear. Lifespan was 50 and 10 are over, remains 40 years. So revised carrying amount will depreciate as per 40 years. But what happens here is that we first remove the old component, now WDV, and we record the new component and depreciate it based on its new life. Is it clear? And you are not doing this here. Here we have an overall account. The overall account, this is carrying amount, includes plus minus. This is revised amount. You have depreciated it based on its remaining useful life and no new life concept. You don't need to do any accounting or calculation for any component you have. In your practical question, if in your practical question talks about components like the interior walls, but leave this, you tell me that how will we know from the paper that this is from different component, this is an integral component. So you will know through life. If you see multiple lives within a question, it should be a sign that the component is being discussed. And if question is about single life, so in the case of a single life, you should know this question should be solved in overall way. What work is there? Tell me. Moving ahead. If there is no different components in the investment property, then it will be accounted for. On overall basis. It will be accounted on an overall basis. For replacements and improvements. There will be no separate column. There will be no separate column for such replacement. But all the adjustments will be made in the following statement. Will be considered statement showing accounting for replacements. Then write carrying amount of investment property write this. The carrying amount of the property should be with you. What will we do for that? Accumulated depreciation, the depreciation you have charged till now. Carrying amount will be obtained by subtracting from the original cost. We didn't create columns. We are not creating different columns. We created single account. We will simply add it to this. Cost of improvements. We have added to it cost of improvements. We will subtract from this scrap from the old materials, if any. Now here, revised carrying amount. Remaining useful life. This will be revised depreciation. After replacements, this means that we will not compute. Profit or loss on the recognition of old asset, because we do not have separate carrying amount. The depreciation will also be computed. According to remaining life of original asset, because the replacement is added to the existing carrying amount. Instead of recognizing it. We won't consider this a separate asset. In the previous class, we did the new asset to bank and considered it as a separate asset, and we took along it as separate life, or its integral. We added in existing carrying amount and deducted in existing amount, and the column is not separate. So life will continue as it was, right? Let's take an example. Original cost of IP. Let's assume it's 20 lakh. And estimated useful life. Assume it for 10 years. There has been depreciation of 2 lakh rupees for 1 year. After 3 years. And an amount of 5 lakhs. Have been incurred on improvements. We have spent 5 lakh rupees on improvements. Scrap. Realized from sale of old material. At the time of replacement, this is for 50,000 rupees. Calculate depreciation. After replacements, and now examine this example. And guys, if you examine this entire sample, then you will get to know that in this entire example, different lives are not appearing. Overall life at 10 years, 3 years have passed since then, so remaining life is 7 years. And here it's not mentioned anywhere that the cost of any interior is within 20 lakh rupees. Neither there is any artwork worth 20 lakhs with different life. There is nothing on different components. If questions state that there is some special work in 20 lakh with this life, and overall life is 10 years, we would have kept track of each component separately. This is simple information. Just add or subtract to create it. Okay? Guys, if you ever have any confusion, you can compare it with the previous question. We had 2 lives. One was 50 years while other was 15 years. Multiple lives are the identification. Calculation of. I know that you have already calculated depreciation. I know about this. You must have started working on this. You must be ahead of me now. Calculation of revised depreciation. The first thing we will write is original cost. I have the original cost of 20 lakh rupees. I will deduct depreciation from this. Depreciation for 3 years. You know very well that this 20 lakh rupees should be divided with 10 years. I hope it's clear. And this should be multiplied by 3 years. 6 lakh rupees. We will subtract from this. This will be the carrying amount. After 3 years, we have Carrying amount worth 14 lakh rupees. Okay. I will add improvements. Improvements. How many rupees of improvements have we made? We have made improvements worth 5 lakh rupees in this. And deduct 50,000. Scrap realized. While this is worth 50,000 rupees. Now please tell, what is the revised carrying amount? What is the revised carrying amount? 14 lakhs plus 5 lakhs minus 50,000. This will be 18 lakh 50,000. Here we will write revised just below carrying amount. Remaining useful life, that is 7 years. 7 years. One is profit loss. If it was different component, then difference of scrap would have been with its carrying amount and profit loss could be found. There's no separate carrying amount, it's overall carrying amount. Do plus minus. Surprisingly, this is the one that you studied in your inter under section 32. You studied this concept of block of assets in Income Tax Act. This is same. Plus on purchase and minus on selling, we don't calculate profit loss even there. I hope this concept is clear. Understand concept of block of assets. You have freedom to understand it as you like it because this is important. Question should be correct in paper. 264. 286. Revised depreciation will be here. Okay. Therefore, we have completed our concept number 6. I am giving you a practical question for homework. You can note this down here. Question number 7 is also for homework. Okay guys, 7th question is also for the homework. What's in this question? Seventh question. I'm giving you homework. For self-reading, you might be thinking what is in this question. You have the carrying amount of the building, 50 lakh rupees, okay? And it's given that they have recently replaced the interior walls of the building, okay? And the amount spent on the new interior is 5 lakhs. It's interior. Information about interior is given. This will be different component. If this is different components, its carrying amount will also be given. And here it's given that the original walls have a carrying amount of 1 lakh. This means that this will be recognized. And this will be recognized. Now guys, when you are given the separate carrying amount of the replaced assets here, then the separate carrying amount will only be possible in component based accounting. Okay? This question is from different components. This question is part of different components. Different components. How the accounting will be done. You will be confused after seeing the answer. This is just plus minus. 5 lakhs are added while 1 lakh is deducted. So this 1 lakh is not being deducted from scrap. However, it's being deducted from carrying amount. Clear? Let me show you. Leave self-reading and homework too. We should not tamper with the concept. It might get disturbed. Question number 7. Solution. This is different component question because you have carrying amount. In this case, carrying amount for interiors is what? Separately mentioned. Carrying amount for interior walls. Which indicates that it's a different component. Write like this. Indicates that it's a different component of main building the following statement when question itself gives the carrying amount, what could be the bigger hint? When there's an integral component, it doesn't have individual carrying amount. It has overall carrying amount. So life is not an issue here. As carrying amount is given, half task is done. Tell me one thing. How was carrying amount of interior walls calculated? For interior walls, how was carrying amount calculated? So, carrying amount of interior walls is only possible if its depreciation is accounted for separately. Depreciation and carrying amount are calculated separately as they are different components. How is it done? Statement showing revised carrying amount. After replacement, how will you do it? Take building, then we have the interior wall. First a building, then we have interiors, and then total existing carrying amount is 49 lakhs. It's 50 lakhs in actuality, but building includes interiors. They're not separate. The carrying amount is 1 lakh rupees. It's for interiors. The total for building is 50 lakhs. Now do the replacements. So what will happen? First will be derecognition. We will remove the derecognition of 1 lakh. Remove carrying amount. Now do recognition. ₹5 lakh will be added. Presentation of answer is in a way which creates confusion, as it seems like it's being added or subtracted, but it's not. This is a shortcut presentation. If question had an integral assumed in it, it won't be possible. To subtract carrying amount, scrap is subtracted. Giving a carrying amount means it's a different component. So revised carrying amount. This is 49 lakh rupees. Here, this is 5 lakh rupees. This is 54 lakh rupees. It's a small thing, but it often causes confusion. And this 54, this particular column was given in answer, but it should be presented like this. In the given question. Scrap value. Is not specified. Due to which? Carrying amount of 1 lakh rupees. Will be written off in profit and loss as loss on replacement. Now in this question you weren't told about scrap. Therefore, when the carrying amount is derecognized, it will go to P&L. Otherwise, entry would be bank debit, P&L debit to old asset. Entry is passed as P&L debit to old asset. Put all in P&L. So this is question number 7. This is not of the integral part, it's a different components question. Because you had the carrying amount, in absence of that, it would be integral. Let's say, if in this question, it is a small matter. If within the same question, I'm cutting this line out. Here you go, I cut this line. Now this question will become integral. And here I will add 5 lakhs to 50 lakhs, making it 55 lakhs. And write a note. The scrap is not mentioned, so it is not subtracted. Revised carrying amount will be 55 lakh rupees. Due to this carrying amount, there will be changes in the answer. Is it clear now? I have repeated everything 3 to 4 times for you. So there should be no confusion. So this is concept number 7. Measurement of investment property. Measurement of IP. Please mark this topic. It is very important. I'm going to explain a very important concept to you because this is related to books. It's about books. What is the meaning of measurement? The first point is that what does measurement mean? You bought an investment property and passed an entry property to bank, recorded in books. The investment property was purchased and recorded in the books. What comes next? So now we will discuss about how this property will be measured in books. Understood? Just buying an investment property won't work out. There are many more clauses that apply to that property. If the depreciation will be applied, or should we book an impairment loss? Is there a revaluation profit possible or not? I'm talking about measuring the value of the property. Students, how do we measure the value of an investment property? We are discussing that concept. Under the Ind AS 40, only one concept is written. And that concept is of cost model. You can just hear this in short. The main point. So, there are no different accounting models for the investment property. There is only one accounting model, and that is the cost model. What does this cost model say? So the cost model says that you should first write the original cost. and then subtract depreciation. Here we have written down the asset's original cost and deducted depreciation. This is normal. Next step is to minus the impairment loss. Impairment loss, if any. Now you might ask, what is impairment loss? Imagine that you bought a property for 10 lakhs and this is the cost. After applying depreciation for 2 years, it totals to 2 lakhs. So students, what is its carrying amount? It is 8 lakh rupees. Carrying amount is same as book value. Now what is fair value of this in the market? That is 6 lakh rupees. And we know that Ind AS 40 states that if the market value of the asset is less than the given carrying amount, if the market value of asset is lower than the carrying amount of asset, what do we call this? We call it downward revaluation. What do you say? Downward revaluation. So these 2 lakh rupees given here should be written off the books. Is that clear to you all? And there will be 2 entries here. First, impairment loss account debit to investment property. Then write P&L account debit to impairment loss. 2 lakhs been written off from property. And now revised value will be 6 lakh rupees. So if there is any impairment loss, so we will subtract it. After subtraction, this will be carrying amount. What is this called? Cost model. So under this cost model, only 2 things are deducted, the depreciation and the impairment loss. And in case if there is no improvement or replacement of the asset, what then? This will keep going. I have explained the accounting for replacement. Normally only 2 things are subtracted, depreciation and impairment. Now a question pops up in students' mind. They ask if in case the fair value is 10 lakhs. If the carrying amount of the asset is 8 lakhs and its fair value is 10 lakhs, what do we call this? Upward revaluation, but this is not allowed. You can go downwards. We are going downwards because we are writing off a portion of the cost. You cannot go upwards. Upward here means that you cannot book gains and you cannot go above the cost. You cannot turn an amount of 8 lakh rupees into 10 lakh rupees. Students, you need to stay within the cost limit. Do not try to go over the cost. Revaluation model is not allowed here. Listen, if the fair value of an asset is higher than its carrying amount, then we call it upward revaluation. Upward revaluation is referred to as the revaluation model. Revaluation model is not allowed for investment property. It is strictly prohibited. You can do downward revaluation of property, but not the upward revaluation. If we move upwards, it will be revaluation model. You will have to open the revaluation reserve, which is not allowed for property because appreciation happens in the property of people. And if people are granted the permission to show this at the market value, what will they do to it? They can increase the net worth by inflating the market value. Therefore, when the property is sold, the appreciation at that time has to be recorded. So, we cannot record the anticipated profit in the books. It is not allowed. And in case it is allowed for an upward revaluation of investment property, then net worth can be manipulated. Imagine a property shown at exaggerated value. It will increase value of assets as well as net worth, but this is prohibited, not allowed. If the value of the property is going down, then you can write it off. But if it is going up, you can't do it. Consider while selling. So please listen to me carefully. In investment property, the measurement rules say that only the cost model is allowed. Now let's come to the Ind AS 16. When it comes to the property, plant, equipment, then both the models are allowed there. However, only one model is allowed for investment property, which is the cost model. Whether you are given PPE or intangible or any of the 2 assets, you can use the cost model there or you can use the revaluation model, but here it's cost model only because by changing the value of property, you can manipulate net worth. Now, as I told you, we have to follow the rules that are laid down under Ind AS. Whether you are convinced or not, when you are giving permission to revalue PPE building, why aren't you doing that here too? Hire an independent valuer and get a certificate from him. If there's a manipulation of value, valuer will be responsible. If he gave you a fake certificate, he will be in trouble. This is pointless. It's international rule. We applied that. Let's apply the cost model. This means that the investment property that will appear on your balance sheet will appear after the depreciation and the impairment loss. But remember, a revaluation reserve cannot be created. We cannot show an upward revaluation. We cannot go upward. This fact is certain. Write this first, then there are 2-3 more things. You cannot go upward. It is not allowed. Revaluation reserve is not allowed. Not at all. As per the provisions of Ind AS 40, measurement of investment property can be made by cost model only. The following statement may be prepared for measurement of property. Then write we will write in this first original cost, then we will subtract from it accumulated depreciation, and then we will subtract from it impairment loss, if any, carrying amount, and we will show this amount on the balance sheet. To be disclosed in if any money is spent on repairs. The repair cost goes to P&L. If replacement is required, add or subtract it here in integral part. And if it's component wise, create a separate column and calculate its value. Within this entire column given here, only a replacement adjustment can be made here. Nothing else. Only factors are depreciation and impairment loss. What is this impairment loss? If fair value of an investment property becomes less than its carrying amount, then such decline will be recognized as impairment loss. The decline is called an impairment loss. Now let's pass its journal entries. Pass the first entry. Impairment loss account debit. To investment property. Being downward revaluation made. Pass second entry. Profit and loss account debit to. Impairment loss is allowed. We can go downward because we write off a portion of the cost while going down. We are not exaggerating the cost here, just writing off a component of it because value decreased. This is allowed. Right under this. Additional points to consider. Additional points to be considered. Point number 1. What would it be? The point to be written down here is that you are not allowed an upward revaluation. You cannot apply the revaluation model. Only the cost model is allowed. You can go downward but not upward. If fair value of an investment property becomes higher than carrying amount of higher than its carrying amount, then you should write then. It should be ignored because upward revaluation is not allowed. In books. under Ind AS 40. It can be said that we cannot apply revaluation model on investment properties. It can also be said that we cannot create revaluation reserve on investment properties. We cannot create a revaluation reserve. We cannot use the revaluation model. We cannot go for upward revaluation. This is not allowed. You will have to keep this in mind. There's one more. Point number 2. Under this point, Ind AS 40 gives you a concession. Ind AS 40 gives you some leeway. Now, what is that? So, consider the fair value. This fair value cannot be included in the books, but it can be shown in the notes to accounts. So if the fair value of the property is higher, then inside the books, its appreciation cannot be recorded in books. Since the revaluation model is not allowed, no problem. You can show this fair value in the notes to the accounts. Clear? You might ask whether it is mandatory to show fair value in notes to accounts. No, it's not. This is entity's choice. If any entity has the property valuation done in its notes to accounts and then it shows the fair value of the property. So this disclosure is encouraged by the ICAI. It appreciates it. You cannot record it in the books. In the books you can go down but you cannot go up. But you want to show this upward trend. Can't show in books, no problem. Add it to notes. Write in notes under the heading of Ind AS 40. We showed the property at fair value. We had the property appraised for fair value. This is it. How can we show it at fair value? It's not allowed. If you feel that your property worth 10 lakhs has become worth 10 crores, you cannot show it in the books, and that is fine. Write this in the notes to accounts. We invested 10 lakhs in this property and independent. Valuer considers it's worth 10 crores. So fair value. Appreciated value can be disclosed in notes to accounts. Not mandatorily. It is 100% the entity's choice. However, if it is done, then this disclosure is encouraged by the ICAI. ICAI encourages you to disclose the fair value in the notes to accounts. Then students ask whether the entities show fair values. So if the value of a property goes through a huge appreciation, then the company doesn't shy away from praising itself. The companies mention it in financial statements. It serves the purpose. Information is conveyed to people. Why not allow it in books too, since it is already allowed in the notes to accounts? How does it matter? Otherwise, the concept of prudence is violated. But how would it get violated here? Concept of prudence is violated when we include any income under the profit and loss. If value of property increases, we do not record the appreciation in P&L. we record it in revaluation reserve. So if something isn't impacting P&L, how is prudence violated? It's pointless. I'm saying that when under PPE, permission is given to revalue land and buildings, so give it here too. It is allowed in the notes too. It has already reached people, right? The purpose is the same. Write in this. As per point 1, the appreciated value cannot be recorded in books of accounts, but it can be reported in. Here I used can be and not shall be or should be. Notes to accounts. Such disclosure will be the choice of the entity, but it is encouraged by ICAI if such disclosure is made. If such disclosure is made in notes to accounts, then ICAI encourages this, okay? Firstly, appreciated value cannot be brought to the books. So where can this value be shown? In notes to accounts, and in that show it outside P&L balance sheet. Okay. Come to point number 3. This is important. Listen to this. This is very important, students. So this needs your attention. Be attentive. If any entity in its notes to accounts wants to disclose the fair value, if it was downward, it would have been there in books. So there is no need to show it in the notes. It will be in notes only if it is upward value. This is common sense, understood. So listen, students, if there is an entity which shows its fair value in the notes to accounts, so this will have to follow a few rules of Ind AS 113. And what is Ind AS 113? It's about fair value measurement, okay. How is fair value determined? Which Ind AS tells this? 113. So if you look at the notes to the accounts and talk about fair value will be determined under guidance of 113. And students, what does 113 say? Fair value that you will show in notes to accounts will be determined by whom? It will be determined by an independent valuer. So this clearly means you will need to get a certificate about it. The fair value measurement should be done by an independent valuer. Independent means the valuer is not from your company. He is unknown person and third party to you. It does not have any connection with company, promoters, shareholders. It is an independent valuer. Clear? Students, a lot of people have done actuarial valuation courses. State and central government have given them a license for valuation. They can do it. If one gets certificate from there, So he will be an independent recognized valuer. So Ind AS 113 states that the fair value that you will record in notes to accounts, that valuation should be done by an independent valuer. Now another point is that so students, when you show the fair value of a property, so the fair value should be all inclusive as a package. Is that clear to you all? Now over here, all inclusive as a package means all the fixtures that are inside the building, like lifts, AC interior, it should be an all inclusive value. Students, it's not possible that you had the building valued separately and then added a lift to it. Then you added walls. Then you added AC. Then you added fans, or then you added lights, and then you added geysers. So students, the fair value of the building is an all-inclusive single package. So if you see written fair value of IP, you have to assume everything is included in that and you cannot add anything to it. Is that clear to everyone? Remember this, that if you add it, the value will inflate. It's not allowed. So the fixtures attached to the property are all inclusive in the fair value. This should be ensured. Let's move on. I want to make you write 2 rules. If an entity goes for disclosure of fair value in the notes to the accounts, then the following rules under the guidance of Ind AS 113 shall be applied This Ind AS 113 is about what? Fair value measurements. This is its title. Title of Ind AS 113 is Fair Value Measurement. Rule number 1. Valuation shall be done by an independent valuer. Independent valuer. Rule 2. Fair value shall be quoted as a single package. It means all inclusive of other assets AC, lift, fans, etc. We cannot consider value of other assets. Additionally, Point number 1. When an investment property is measured, it will be done based on the cost model. Clear? Students, you can deduct depreciation and impairment loss. Okay. If there is any upward. And there is fair value. So we will ignore it. A revaluation reserve cannot be created because the revaluation model is not allowed. You can show the fair value but in the notes to the accounts. And this is also not mandatory, it is a choice. If you do that, then you will have to go to an independent valuer and get an all-inclusive comprehensive valuation done. The valuer will go to the site and inspect the building, its location, age and other factors. He will provide you with certificate according to condition, then it will be reflected in notes. The auditor will verify it. It's a simple thing. I want to ask you a couple of questions about this. You should read about this. I have the question number 20. I marked this as important and you can write in your book in brackets. Fair value, notes to accounts, fair value, notes to accounts. I will read the question to you. You know assumptions. If you need time to read questions, so you can press pause. However, in this question, I want to point out one error. Here it is not 25 million. It's not 25 million here. It's not 25 million here, okay? Listen to me, I have mentioned a few times. Instead of 25, it is 32 million here, okay? I am starting to read. So listen, students, the fair value of an investment property at the beginning of 15-16 is 25 million. Now at the end of 15-16, the fair value is 32 million. I have created a timeline. 1 April 2015 and then March 31, 2016, okay? Here the fair value was 25 and here the fair value is 32. I have corrected it to 32. Let's move on. What does question say? It says that there is an air conditioning plant which was purchased at the beginning of 13-14. How many years? 13 to 14. 14-15. It has been 3 years since 15-16. There is an AC plant installed inside the building, okay? So here it has been 3 years since the AC plant was installed. We have invested a total of 1 million. Tell me the depreciation. It depreciates at 10% per annum, okay? When question does not mention SLM or WDV, so assuming SLM is easier than WDV, SLM is assumption. So if it is 10% for 1 year, then for 3 years it will be 30%. So students, over here this means that our AC is 1 million into 0.7. Do it 70%. 70%. So it will be 0.7 million. It was 1 million. There would have been 3 depreciations of 10% each, totaling 30% and leaving 70% value. Then there is a lift in it. This lift was installed in the beginning of 11-12. 11-12, 12-13, 13-14, 14-15 and 15-16. It was applied 5 years ago. Lift was applied 5 years ago. The lift was installed 5 years ago and its cost is 1.2 million. And its depreciation is also 10% off. So within 5 years it is 50%. So 1.2 of the lift, we will take 50%. This is 0.6. According to paragraph 50 of Ind AS 40, So company wishes to present an all-inclusive fair value of investment property. So they want to show the all-inclusive fair value of the investment property. This is 32 million. So tell me one thing. Let's suppose if the AC plant costs 32 million. This is amount of lift. What is balance? Balance will be building. The rest is building. You have separated the AC and the lift, rest is building. So you cannot add the lift and AC to 32. This means that you will add them to this, you will add them to this. Is that clear? It will be 33.3. No students. We will deduct it from this. This is all inclusive. This is 32 and it includes everything. Okay. So what does the question say? Let me see. I have explained question. Cancel it, move forward. Assume that depreciated value of the equipment represent the fair value at the end of the year. This says that the lift and AC, the fair value of will be the book value after deducting depreciation. Its fair value was not measured separately. The company is in a dilemma about which procedure to follow. For the fair value measurement, we will now demonstrate question 20. Solution. Statement showing fair value measurement of property. But remember, we are doing all this work just for the notes to the accounts, okay? Remember this, students. First I will write air conditioner. We had invested 1 million. And we'll do 70% of it. It will be 0.7. Then we have the lift. We installed the lift for 1.2 million rupees. We will apply 50% on this. This will be 0.6 million. Investment property. Balancing a figure. Why? Because total fair value is 32 million. And this is given. This is 32 minus 1.3. So 30.7. Assumption. Depreciation has been charged on SLM basis. This is assumption. In the note, given fair value of 32 million on balance sheet date has been considered as a package which is all inclusive. Okay. This presentation will be done. The chances of this question coming in the paper are very low because it's not from study material. I saw it in a professional commentary, so I gave it to you. Is that clear to you all? So now, this RTP, MTP past exam study material is not available anywhere. I got this from a professional commentary. Okay, students? Because what is important for my children is also important for me and for good marks. I admit it. Mr. Dolphy D'Souza's professional commentary has this. Let's move on. So what do you think? You will study from your study material and that will be sufficient for the exam. Is it so? You have to refer to the professional commentaries for understanding. Let's move on. Let's check another question. So this is about I had one more small question. I'm just going to discuss question number 13. This is part of homework. In it there is only calculation of depreciation and nothing else. So this question is also given in your study material. Tell me one thing. How much did you buy the property for? There is no need to note. It is not even a final level question. You bought a property for 40 lakhs. Tell me what is its lifespan? 20 years, right? And it is telling you that the salvage value is 2 lakh rupees. And on SLM basis, you have to apply depreciation. Students, here you have to tell carrying amount. This is easy question while learning at such high level. It is 40 lakhs. This is cost. Subtract depreciation. So 40 lakhs minus 2 lakhs divided by 20 years. Now calculate it all. Is that clear? 40 minus 2 and then divided by 20. So this will be 1,90,000 as depreciation. The carrying amount is 38 lakhs 10,000. So students, this is a very easy question. This question is about the cost model. Is that clear? There is no fair value and fair value measurement. Is that okay, students? So in your homework, write it in the corner of your copy. Let's move on. So now, let's start. Concept number 8, 7 is done. We have already done 7. This was 7, right? Yes, now new concept. Concept number 8. And its heading is transfers. You should also be familiar with this concept. So students, you have an investment property. Ind AS 40 is applied. This means it is held for rental and appreciation. Did you understand? So students, you have an investment property. You are applying 40 on it. This is available for rental and appreciation. But now your intention has changed. You felt that we don't have to rent it out. You have different motive. We will use this for business purposes. You stopped letting it out and started using it for business. Is that clear, students? So students, pay attention over here if you have covered any property for 40. And later on your intention changes that I'm going to use it in the business. This is my PPE. This is called a transfer. Transfer means change in heading. And change in heading can be in many ways. So you will have to transfer it to Ind AS 16, okay? This could also be the other way around. You were previously using this property in your business. Remember, you were going to put 16 on it. But now your intention has changed. You felt that we will take it out. Then you will have to wait. It could also be taken from 16 to 40. It was held for rental. Start using it for business purposes. So it will be transferred from 40 to 16. We were using it in the business. Then we started to let it out. It will start from 16 to 40. So there was an IP in Ind AS 40. And students, you did put into cell. I will take example of DLF. DLF built mall and has BN renting it out. But now DLF feels they will sell the shops in the mall. Okay? If you put it on sell, then it's okay. We will change it Ind AS 2. It will go to Ind AS 2 from 40 to 2. It's also possible that something was put on sale for us and we are converting it to investment property. It could be vice versa. Initially DLF thought to sell mall but later decided not to. They will rent from 2 to 40. Vice versa cases can also be created. From 40 to 16, 16 to 40. From 40 to 2, then 2 to 40. So students, when we change the category of land and the building based on the intention, so we call it transfer. Okay. It is called transfer. So what should be done in this? The first thing, there are no journal entries passed in this. You had land and building before, you still have it today. What entry will you pass for it? There will be no journal entry passed for this. Only in balance sheet, changes come in the headings. Item we showed in balance sheet as PPE will now be shown as IP, or if it was shown as IP, it will now be shown as PPE. The heading changes. First of all, in case of transfers, if your intention changes regarding any of the property, so students, no journal entry will be passed, only the headings will change. Point number 2, you should have knowledge about second point. Children often think it's about transferring from one heading to another. Do we go from 40 to 16 or from 16 to 40? What value will it be on? Which amount will it be? So now students, for this, you need to remember that the transfer should be on the carrying amount. On whom? On carrying amount. You have the balance sheet value should not be tampered. Okay. The value at which you are seeing it in the balance sheet, it will be transferred at the same value. For example, I have an investment property at 40. I'm taking this with me in PPE in 16. I have the carrying amount of this. Carrying amount of this is 10 lakhs. Is 10 lakhs. And I have the fair value of this. The fair value is 6 lakh rupees. On what date? Will these two things are on transfer date? The information for transfer will be available to me on the day of transfer. Keep one thing in mind, fair value isn't taken. We will transfer it for 10 lakh rupees. 10 lakhs will be deducted here and added here. What will happen? Now you have reached 16. So now the measurement of this property, we will do it as per 16. The impairment loss that you are seeing here for 4 lakhs, this will be recorded by the Ind AS 16 and not by Ind AS 40. What I mean is that, remember, you don't have to measure the value before doing the transfer. The value will be measured after transfer. The Ind AS under which the property falls now, right? That Ind AS We'll see what's to be done. The day on which you are making the transfer, on the actual transfer date, don't look at the fair value if it's high or low. You only need to look at the carrying amount. Carrying amount refers to WDV. Just transfer the value that is recorded in your books. Once it comes to the new Ind AS, then that Ind AS will consider and look after its measurement, whether to increase it or decrease it. After the transfer, the Ind AS that is new will do its measurement and take care of it. So this is very important, and please remember this. Firstly, you need not pass the journal entry. Secondly, do not measure. Transfer at carrying amount. If needed, measure after the transfer according to the new Ind AS. Okay. This means that the transfer refers to a change in the intention of use. You have changed the intended use and it has been transferred. You should write. If an entity changes its intention of use. So if an entity changes its intention of use regarding its land and building, then its land and building, then it will be considered as a case of transfers. It will be considered as a case of transfer. There may be many cases. Under the heading of transfers, earlier, now, IP, held for rental. Earlier we were applying 40. Held for use. In business. Now we will apply 16. We're at second point now. Land and building. Remove the word IP. Held for use in business. We were applying 16, but now held for rental. We are seeing the vice versa here. Can go from 40 to 16 and come back from 16 to 40. It's up to the owner. If it is leased out, 40. If it is used, then 16. As soon as the intention changes, transfer case will be applied to it. Held for sale. Held for rental. We were applying 40. But now we are being told to put it on sale. If it's written with the intent to sell, then point number 4. Before it was put into sale. Now it's held for rental. This one here, I've written 3 to 4 things, for example. You can create as many as you want. For transfer, if the intention of use changes, then your transfer will happen. There could be many more cases. My aim is to explain the concept, rest you can do. Additional points to be considered. Additional points to be considered. First thing is, there will be no journal entry. There will be no journal entry for such transfer. From one heading to other heading. The presentation will be changed. From the point of view of the balance sheet only. Presentation will change as per the balance sheet. The transfer of property, transfer of land and buildings from one heading to other, will take place at carrying amount only. The fair value measurement will not be considered. On the date of transfer. We won't measure at fair value that day. We'll transfer it at carrying amount. The fair value measurement will be considered under Present Ind AS rules. Which is presently applicable. Which is presently applicable. After such transfer, after the transfer, we will count on the Ind AS that is presently applicable. We will only count on the present Ind AS. We will only count on the presently applicable one. The present Ind AS will only be counted, that's it. The transfer is at carrying amount and no entry should be passed. Fair value measurement shouldn't be done. If needed, the Ind AS used after transfer will be applicable. Okay. I have a small question on these points, the 21st question. Write transfer in brackets next to it. This question is on transfers. I will start reading this for you. The X Limited company has the following 4 properties. How many properties they have? 4. They have 4 properties. Property A, which is actually used as what? An office building of the company. If property A is an office building, then 16 is being applied now. 16 is being applied now. The cost is 30 crores, the depreciation is 20 and the carrying amount is 10. 30 minus 20 is 10. What happens now? The company puts the property into renovation and intended to lease it out under 1 or more operating leases. Operating lease means we will let out. If we let out, then this will go under 40. It's the first case. The property is in 16 now and will go to 40 as it's going to be an operating lease. So this case is gone from 16 to 40. Okay. And the value is 10 crores. It's the carrying amount. Next point. Property B is with them and is being used under an operating lease. You know what an operating lease means? Let out. 40 is applied for this. It costs 50 crores and depreciation is 20 crores. Its WDV has also come, which is 30 crore. 50 minus 20 is 30. And this property B is actually put into renovation for sale. Put for sale Ind AS 2. So this goes from 40 to 2. Third one is the property C is being used under an operating lease. Let's discuss it. If we're using it in an operating lease, then it's a let out. So we'll use 40. The cost is 40 crores, 20 crores of depreciation. So the carrying amount is 20 crores. The property is put into sale. Let's discuss. Put into sale. So this is the same case then. The same case. Property D. Property D is used under an operating lease. Operating lease again. We'll use 40. 40 crores, 20 crores, carrying amount is 20 crores. Property is put into renovation and intended to be used as office building. It will be under 16. Go from 40 to 16. The first case. The first case is from 16 to 40. In next 2 cases, we are going from 40 to 2 and this is going from 40 to 16. The space that was rented before will now be used as the office building. How should the transfer be evidenced? How would these transfers change the classification of the respective property? Let's write the solution. we can evidence the transfers only from intention. Of use from entity point of view. We can apply different Ind AS on same building for second point. The following transfers have taken place. In the given question. First is the property A will be transferred from Ind AS 16 to Ind AS 40 at rupees. So the property A here 30 crores, 20 crores, 10 crores was used as office building. It was an office building, so we applied 16, now we'll rent it out. At the carrying amount of rupees 10 crores. It was earlier used for business purpose, but now it will be let out. For rental purpose. We'll come to point B. B and C, we write them together. First write B. The property B will be transferred. Will be transferred from Ind AS 40 to Ind AS 2 at a carrying amount of, tell me, it was earlier on lease, now on sale, 50 crores, 20 and 30. 30 crores. It was held for rental purpose. But now it is put into sale. C. Property C will be transferred from 40 to 2 at carrying amount of rupees. You can do the presentation. From 20 crores it was held for rental purpose earlier. But now it is held for it is put into sale. We come to D. The property D will be transferred from Ind AS 42, Ind AS 16. At a carrying amount of 20 crores. It was held for rental purpose, but now it will be used for business purpose. I know I wrote it quickly. I have written it like a doctor. But I also know that you can pause me when needed and complete your notes. Students, today I have explained 8 concepts to you and completed till transfer. In the next video, I will first teach you disposal and how to sell. Then I'll teach disclosure. The lecture is over. In the next video, we'll cover the rest of the questions. I'll wind up in AS 40. See you in next video. Thank you all. Take care. Bye-bye. Love you all. Bye-bye, students. There is no homework today. Okay, no homework today. Okay, bye.